Now we're going to begin our look at Unit 2, Practical Economics, how it works for you. In this unit, you'll find out how basic economic principles can help you in your daily life, what pitfalls to avoid when going into debt, what you should be aware of before buying a vehicle or a house, and why saving and investing are sound economic habits to learn. The 4 chapters in Unit 2 address how economic theory applies to everyday buying and budgeting. Chapter 3 explains disposable and discretionary income, the role of advertising and consumer rights. Chapter 4 explains what causes families to go into debt and how to manage debt wisely. Chapter 5 discusses responsible budgeting for food, clothing, housing, and transportation. And Chapter 6 describes options for saving and investing. Our unit objectives. After studying this unit, you will be able to evaluate the individual role of the consumer. You'll be able to analyze buying decisions, understand how to balance a budget, and learn the value of saving and investing money. Chapter 3, Your Role as a Consumer. Why it's important. If you are thinking about buying a computer, should you visit every computer store in the area? What should you do if your purchase is defective? This chapter will help you learn to make rational consumer choices. Chapter 3 explains the difference between disposable and discretionary income and examines how each is spent, explores the role of advertising, and reviews the rights and responsibilities of consumers. Section 1 explains the difference between disposable and discretionary income and describes the 5 considerations in consumer decision making. You and everyone around you are consumers and as such play an important role in the economic system. A consumer is any person or group that buys or uses goods and services to satisfy personal needs and wants. Consumers buy a wide variety of things: food, clothing, automobiles, movie tickets, and veterinary care. In this section, you'll learn how to spend or not spend your income wisely. For most of the 20th century, athletes were not paid the millions of dollars that seem so commonplace today. In fact, many players took a second job during their off-season so that they could pay their bills. Yankees ball players Phil Rizzuto and Yogi Berra even opened a men's clothing store. Would you be more likely to visit a store owned by a famous celebrity than one owned by a non-celebrity? Would you be willing to pay 10% more for an item in the celebrity's store? The ability to consume depends on a person's available income, how much of it is spent or saved. Disposable income is money that is left after paying all taxes, whereas discretionary income is money that is left after paying for necessities, or money that can be spent on luxury items or be saved. So an example of this is that when we talk about disposable income, you can almost think of that in essence as your take-home pay. After you deduct out the taxes, that's what you have left. But out of that money, you're probably going to have some bills to pay. Especially, as an adult, you'll probably have a mortgage payment, car payment, food, clothing, utility bills, basic necessities that have to be paid for. So discretionary income is the money you have left over after you've paid all of your bills. And so, it's a narrower definition than disposable income. Education, occupation, experience, health, location, and wages can all influence a person's ability to consume. Spending income requires constant decision making.
The Department of Labor provides a detailed look at how U.S. consumers spend their income. Who is the average American consumer? Well, they look a lot like Avery. He's 49 years old, creeping up on 50. Owns his home and brings in a little over $40,000 a year. Where does Avery spend the money he works so hard for? Take a look. 26.5% is walled up in housing. 8% goes toward insurance assurance. 2.7% gets dressed up in clothing and other services. 12.3% speeds away for transportation. 3.4% is guzzled up by gas. 9.8% gets chomped away for food. 4% is dazzled away by entertainment. 5% is injected into healthcare. The rest? Miscellaneous stuff. And that is how average Avery spent his paycheck. How do you spend yours?
Decision making as a consumer. In order to decide whether or not to buy an item, consider time cost. How much time will you invest in research? Opportunity cost. What will you give up to make the purchase? Rational choice is making a decision based on opportunity cost. You want to choose the best quality item that is the least expensive and will satisfy your wants. Rational consumers will all make different choices. Section 2 explains or describes the trade-offs required in gathering buying information, various forms of advertising, and how consumers practice comparison shopping. The goal of advertisements is to win your consumer dollars, and advertisers are willing to spend millions of dollars to attract your attention to their products. Because of the problems of scarce income and time, however, your goal should be to obtain the most satisfaction from your limited income and time. In this section, you'll learn about the 3 basic buying principles that can help you and all consumers achieve this goal: gathering information, using advertising wisely, and comparison shopping. Advertisements have a powerful effect on consumer choice. Around 60% of swimsuits purchased are never used for swimming, yet Americans spend almost $2 billion annually on them. How many shops would you visit, and how much information would you gather before purchasing a swimsuit? Gathering information. Compare competing products and competing stores. Filter information to focus only on what you need to know. Use the internet to help research products and companies. Competitive advertisements try to convince people that one product is better than another product and to try to create brand name recognition or loyalty. Informative advertisements provide information about the product, such as the price or features. Bait and switch. This is a selling method in which a customer is attracted by the advertisement of a low-priced product, but then is encouraged to buy a more expensive one. This type of advertising is normally illegal. Now, the key here about bait and switch and what makes it illegal is that it is deceptive advertising. So, the thing is that you need to be aware that there are techniques that stores will use that can be legal to create the same effect as bait and switch. Now, in comparison shopping, you want to compare different stores and companies, use information obtained from other stores to negotiate lower prices. Some stores will match other stores' prices. Also consider the different product warranties. Compare the value of generic/store brands to brand name products. Section 3 explains or describes consumer rights, private and government agencies that protect and enforce those rights, and the relationship between consumer responsibilities and ethical behavior. Protecting consumers. There are many private and government agencies that work to protect consumers, but consumers must be proactive. In this section, you'll learn how you personally are affected by consumerism, a movement to educate buyers about the purchases that they make and to demand better and safer products from manufacturers. Have you or anyone you know ever contacted a consumer organization? Why? Do you think that people benefit from such organizations, even if they never use them? Consumer rights. Businesses are now responsible for product safety, healthful food, and accurate advertising. Since 1962, consumers have the right to buy to product safety, to be informed about their product, to choose from a variety of products, and to be considered in making laws about products. Consumers also gained the right to redress or obtain payment for damages caused by products. How to protect yourself. Complain to store managers and manufacturers when dissatisfied with a product. Better Business Bureaus give information on products and help to settle buyer and seller disagreements. Be a responsible consumer. Do your homework. Initiate the problem-solving process when a product or service is faulty. Behave honestly and ethically. Facts can be verified. Opinions are subjective and thus cannot be verified. Chapter 4. Going into debt. Why it's important. How do credit cards work? What happens if you can't pay back the amount of credit you've borrowed? This chapter will explain what you need to know before applying for credit and going into debt, and how to use credit wisely. Chapter 4 explains the advantages of buying items on credit and why people decide to use credit. 6 types of credit lending institutions, how credit ratings are determined, and borrowers' responsibilities. Section 1 explains or describes the importance and uses of consumer credit and loans in the economy, the advantages of repaying loans over the long term, and why and how consumers decide to use credit. Americans use credit to make many purchases. The total amount of funds borrowed each year and lent each year is enormous. In addition to individuals borrowing funds, the federal, state, and local governments all borrow funds too. The nation's economy, in fact, depends on individuals and groups being able to buy and borrow on credit. The average American household with at least one credit card has nearly $15,950 in credit card debt in 2012, according to creditcards.com. What is a credit card? What kinds of things might you purchase with a credit card? What is credit? Credit is to receive funds for services or goods with the intent of paying back those funds in the future. Principal is the amount that is originally borrowed, and interest is the amount that is added on for the privilege of borrowing. Why do lenders such as banks charge interest? Installment debt. A loan paid back in equal payments over time is an installment loan or installment debt. This is used for the purchase of durable goods or manufactured products that last over 3 years. Longer payback periods have lower payments, but higher total interest. Mortgages on houses are a popular form of installment debt. The above chart indicates that back in 1980, the consumer credit per person was $1,540, which was 7.3% of the average household income of $21,100. In 2013, the consumer debt was $9,800 per person, which was 13.4% of the average household's income of $72,600. This means that debt increased 70% faster than income from 1980 through 2013. So here's an example of a $1,000 installment loan at 8% interest. So here you can see the term of the loan at 24 months. Monthly payments would be $45.23. Total interest paid would be $85.52 for total payments totaling $1,085.52. Now, on a 36-month loan, or 3 years, the monthly payments would only be $31.34, but you would pay $128.24 in interest for total payments of $1,128.24. So you can see it is more expensive to spread it over 3 years rather than 2, but your monthly payments are lower on the 3-year as compared to the 2-year. Why people use credit? People use credit to make large purchases and spread the cost over the life of the product, to satisfy an immediate need or want, to make emergency purchases like car repairs. Should you use credit? It is almost impossible to make major purchases like a home without using credit. To build a credit rating, it is important to use credit sometimes. In deciding whether or not to use credit, consider the cost of credit and the benefits of making the purchase now. Consider the opportunity cost of not being able to make other purchases. Section 2 describes the credit choices available to consumers and how to calculate annual percentage rates and finance charges. There are 2 major ways of using credit: using a credit card, such as Visa, MasterCard, American Express, etc., or borrowing directly from a financial institution. All lenders charge interest for the funds that they loan. In this section, you will learn about the types of credit and financial institutions. You will learn how they charge interest and how to make wise choices when using credit. Types of financial institutions. Commercial banks are for-profit corporations that are usually owned by private investors. They offer a wide range of services to consumers and corporations around the world. Savings and loan associations often have lower interest rates than commercial banks. Credit unions are owned and operated by their members and generally have more favorable rates. Finance companies manage stores' installment loans and usually have very high interest rates for loans. Charge accounts enable a consumer to buy something and pay for it later. Regular charge accounts have credit limits, a 30-day billing cycle, and charge no interest if the bill is paid in full each month. Revolving charge accounts have a minimum payment due each month, and interest is charged on the outstanding balance. Installment charge accounts require equal payments spread over time, and part of each payment goes to principal and part of it goes to interest. Credit cards are widely accepted, have higher interest rates due to delinquent loans, and offer lower introductory rates to attract consumers often. As you can see here, 0% APR Platinum Rewards. Finance charges and annual percentage rates. A finance charge is the entire cost of borrowing, including interest and all fees. The annual percentage rate is the cost of credit expressed as a yearly percentage. Debit cards. Debit cards are not a loan. Debit cards transfer funds directly from a person's bank account to the store. Section 3 explains or describes the factors that establish a person's credit rating, the difference between a secured loan and an unsecured loan, and the responsibilities that a borrower assumes on taking out a loan. How can you obtain credit? How should you manage debt? In this section, you will learn the factors that determine a person's credit worthiness and how to manage your debt. Credit worthiness. To obtain credit, you must fill out an application. The lender hires a credit bureau to do a credit check. The credit rating reflects how risky it is to lend a person money. Factors considered include a person's income, the amount of debt, character, and personal wealth. Secured loans are backed up with collateral. An example would be car loans and home loans. Unsecured loans do not require collateral. Cosigners assume the responsibility of repayment if the borrower defaults. Now, sometimes you may be able to get an unsecured loan, but they may require that you have a cosigner, somebody else generally who has a better credit rating, who in essence will take the risk that you're not going to go bad on that loan. Responsibilities as a borrower. You're responsible to repay your debt on time. You're responsible to not go over your credit limit and not to take on more debt than you can handle, and to carefully plan how to manage your debt. There are two different strategies that people can use for managing debt. One would be to repay high-interest loans first. This one makes sense because if you repay the higher interest loans first, you're going to be saving money on the amount of interest that is paid. The other strategy is to repay the loans with the lowest balance first, and once paid, add the payment to the next lowest to pay it off faster. Section 4 explains laws that regulate the credit industry, including the bankruptcy process. Both the federal and state governments pass laws that regulate the credit industry in order to protect consumers. Some states set maximum interest rates that can be charged for certain types of credit. The federal government has also passed laws to make certain that borrowers are fully informed about the terms of their loans. The Truth in Lending Act, passed in 1968, was the first law to expand the government's role in protecting the users of consumer credit. It was designed to make certain that borrowers were fully informed about the cost associated with using credit. The Equal Credit Opportunity Act, or ECOA, states that individuals cannot be discriminated upon via factors that are not directly related to their creditworthiness. It prohibits creditors and lenders from considering a consumer's race, color, national origin, sex, religion, or marital status in deciding whether to approve their loan or credit application. State usury laws. Regulations governing the amount of interest that can be charged on a loan. Usury laws specifically target the practice of charging excessively high rates on loans by setting caps on the maximum amount of interest that can be levied. These laws are designed to protect consumers. Personal bankruptcy. Personal bankruptcy is designed to provide protection for people who cannot repay their debts. When filed, the debtor can protect some possessions, but the rest are auctioned off and distributed to creditors to compensate for the loss. Creditors are forced to forgive all debt. Bankruptcy can stay on your credit record for up to 10 years. Chapter 5, Buying Necessities. Why it's important. Should you buy a new or used car? How much do you spend on clothing? Where should you buy your groceries? Should you buy a house or just rent? This chapter will help you make wise consumer choices when buying necessities. Chapter 5 explains how to maximize your food dollars, how to obtain the best value in clothing, the pros and cons of buying or renting a home, and the cost associated with owning and operating a car. Section 1 explains the trade-offs involved in shopping for food. Americans consume a wide variety of foods, purchased in a wide variety of stores. On average, Americans spend more than $150 a week on food. In this section, you'll learn how to get the most from your food dollars. Comparison shopping. Comparison shopping for food includes deciding what to buy and where to buy it. Consider time and transportation cost when comparison shopping. You can save time and money by using advertisements, coupons, and club savings. Trade-offs in food stores. Club warehouse stores generally offer the lowest prices, but their items are sold in large quantities. People also tend to spend more when shopping in club warehouse stores. Convenience stores carry few items, but they have the highest prices, but they're open for more hours. Brand names are well known nationally or regionally. Some supermarkets or wholesale stores have their own store brands, and generic products have no brand name at all. Section 2 describes 3 factors that determine clothing value and explains when consumers should take advantage of clothing sales. Americans spend about $400 billion annually on clothing and other personal products. Most people could save considerable income by purchasing only a few very durable pieces of clothing. The clothes, however, would not serve another purpose: variety. In this section, you'll learn that variety for Americans is typically the motivating factor involved in clothing choice. Waist overalls was the term used in the mid-1800s for the newly created denim pants that became so popular as work pants. Today, jeans, a word that wasn't used for another 100 years, are more popular than ever. Why has this style of dress endured for so many years? Comparing clothing value. Buying current styles, which tend to change each year, can be expensive because new clothes must be bought annually. Buying classic styles, which are more basic and do not change as much, will help your clothes last longer, saving money. Durability is how well something lasts over time. Service flow is the amount of time that you get to use the product and the value that you place on that use. You should factor in the cost of care involved in the clothing that must be hand washed or dry cleaned versus machine washable. More for less. Clothing costs have decreased significantly over time. Clothing sales generally happen at the end of the season. Now, once again, if you're trying to stay on the cutting edge of what you're wearing, then end of the season sales are really kind of a difficult time because you're buying right at the end of the season. But if you tend to stick with more classic styles that change little from year to year, you can get good deals on clothes that'll still be pretty much in style the next year by buying, like I said, more classic styles. Bargain fanatics buy items just because they are on sale. If you buy an unnecessary item because it's on sale, you may not be saving money at all. Section 3 explains or describes the pros and cons of renting or buying a home and the rights and responsibilities of renters. Some people will save for years in order to buy a small house. Others take out huge mortgages to purchase large homes. Still, others are content to rent a house, condo, or apartments most of their lives. In this section, you'll learn about renting versus buying. Wise consumers should consider both when deciding whether to buy or rent housing. In 1997, Americans spent around $119 billion on home improvements. In the year 2005, it was predicted that they would spend $180 billion on home improvements. What kind of improvements might add to the value of your home? How much should you spend? Avoid spending more than you can afford. You will need cash for the down payment and closing cost. Be aware of points or interest fees that are paid to the lender. Financing the purchase of a house. Many different types of mortgages and financing packages are available. Mortgages involve down payments and interest. Mortgages are paid in monthly installments. Property tax, homeowners insurance, and mortgage insurance are often included. Renter rights and responsibilities. Renters usually sign a lease. Be aware of the clauses in your lease and read it carefully. Tenants have a right to use the property for the purpose stated in the lease and a right to privacy. Tenants must pay their rent on time, take care of the property, and notify the landlord if major repairs are needed. Some tenants must place a refundable security deposit in case of damaged property or unpaid rent. Tenants must give written notice if leaving prior to the lease's end, which can result in fees and fines for breaking the lease. Landlords must provide minimum services and obey building and safety laws. Rent control laws limit the amount a landlord can charge in rent. Section 4 explores the cost of buying and operating a vehicle and provides a checklist for automobile buyers. As with every decision in life, when you decide to buy a particular type of car, you are going to make a trade-off that involves an opportunity cost. 3 of the major trade-offs include the following. The smaller the engine, the less gas an automobile burns. This makes a car with a smaller engine less costly to operate, but the car will accelerate less quickly. Newer automobiles cost more, but they require fewer repairs than older ones. The smaller the automobile, the more energy efficient it is. In an accident, however, larger automobiles usually protect passengers better. In 1925, the best-selling car in America was the Ford Model T. It sold for $660, which represented 7 months' wages for the average American. In 2001, the best-selling car in America was the Honda Accord. The suggested retail price for the Honda Accord was $23,350, or the equivalent of 6 months' wages for the average American worker. Besides the purchase price, what other costs are associated with operating a motor vehicle? Buying and operating a vehicle. Registration fees are state fees that are paid each year. Normal maintenance and repairs. Cost of buying an extended warranty that covers problems beyond the time frame in the warranty offered by the manufacturer or dealer. These are all additional costs that you have to consider when buying a car. Depreciation or a decrease in the value of a car as it ages is something that should be considered. Some cars depreciate faster than others. Most states require liability insurance that covers both bodily injury and property damage. The cost of insurance varies based on age, sex, and driving history. And of course, if you're buying a new car or even a car that you're going to be financing, even if it's a used car, whoever's financing the car is most likely going to require you to carry full coverage insurance, which would mean you would have coverage for collision and comprehensive coverage. Liability insurance only covers damage done to another party in an accident. It doesn't cover your car. But if you have a newer car, or if you're financing a car, it's probably a good idea to carry full coverage insurance that would cover comprehensive claims, which would include maybe what we might consider accidents of God, things like a tree falling on your car, or flooding, or other ways it could be damaged in a natural disaster, as well as, of course, theft, vandalism, and of course you want to have coverage for collision in case you are at fault in an accident as well. You can get your own vehicle repaired. Chapter 6, Saving and Investing. Why it's important. Why should you save? What is the difference between saving and investing? This chapter will explain reasons for saving, as well as the various institutions and investments in which to put your money. Most Americans make more income than they require for immediate needs. At the same time, many large purchases cost more than a worker earns in a single pay period. Thus, wage earners must decide whether to save their extra earnings for large purchases or to invest them for future use. Chapter 6 describes various types of savings accounts and investment opportunities and explains their advantages and disadvantages. Section 1 describes the different kinds of savings accounts available through savings institutions and explains the advantages and disadvantages of time deposits as compared to other savings accounts. Economists define saving as the setting aside of income for a period of time so that it can be used later. You may already be saving some of your income for a future use, such as buying a gaming system or continuing your education. As you read this section, you'll learn why saving is important to you and the economy as a whole. In 1967, Americans saved around 8.6% of their disposable income. By 1996, that amount dropped to 4.3%. Why do people save money? Where do they keep the money that they have saved? Deciding to save. People save for purchases that require more funds than available, for emergencies, and for retirement. Economies benefit from individuals who save because people have more money to invest or spend, leading to expanding business. When choosing a place to save, think about trade-offs. Passbook, regular, or statement savings accounts accrue a low interest, but they allow immediate access to funds. Money market accounts accrue higher interest with immediate access through checks, but they have a high minimum balance requirement. Time deposits. Time deposits refer to a wide group of savings plans or certificates of deposit, also known as CDs, with a high interest rate that increases over time. But a person cannot remove the funds before a certain time period or maturity without paying a penalty. Before the 1930s, people could lose all of the money in their accounts if the bank failed. Fortunately today, banks are insured by the FDIC. Most banks are FDIC insured, which is the Federal Deposit Insurance Corporation. So this is a federal government-owned corporation that insures bank accounts in FDIC member banks up to $250,000, giving people security when making deposits. Section 2 describes and explains stocks and bonds and the differences between them, and how the government regulates the stock and bond markets. People have savings plans because they want a safe rate of interest. If people are willing to take a chance on earning a higher rate of return, however, they can invest their savings in other ways, such as in stocks and bonds. Stocks and bonds offer investors greater returns, but with more risk. As you read in this section, you'll learn what stocks and bonds are and why they carry a risk. In 1792, a group of 24 businessmen met under a buttonwood tree in New York City. In 1817, a building was built on this spot and formally made into the New York Stock Exchange Board. Since 1863, it has been known as the New York Stock Exchange. Why do companies sell stocks? Why do people purchase stocks? Stocks entitle the buyer to future profits and assets of a corporation. Stockholders make money through dividends, which is return on bought stock, or by speculating, buying stock hoping that it will increase in price so that they can sell it at a profit. A capital gain is money earned by selling stock for more than you paid for it. A capital loss is money lost by selling stock for less than you paid for it. A bond is a certificate promising to repay a loan at a stated interest rate. Stocks and bonds. A bond holder is not part owner of the organization. Tax-exempt bonds earn tax-free interest. With savings bonds, you pay half the bond's face value, and the interest increases yearly until the face value is reached. T-bills, T-notes, and T-bonds are government bonds that are exempt from state and local tax and are mainly for larger investments. Stocks are bought and sold through brokers. Stocks are traded at stock exchanges. Stocks that are not traded in a specific place are called over-the-counter stocks. Bonds are sold on exchanges and over-the-counter markets. Mutual funds are investment companies that combine many investors' funds to buy a large variety and quantity of stocks. Some mutual funds mirror index funds. Managed mutual funds have managers who adjust the mix of the stocks bought and attempting to generate the highest yield. Money market mutual funds allow investors to write checks against the money in the fund. Government regulations. The Securities and Exchange Commission, or SEC, regulates brokerage firms, stock exchanges, and most businesses that issue stock. Congress passed the Securities Act to avoid another stock market crash. The act requires a prospectus to be given to each potential buyer of stocks or bonds. A prospectus is basically a detailed statement on a company that includes the financial health and outlook of the company. Section 3 describes the types of retirement plans available and discusses investment strategy. One of the reasons that people save is to send their children to college. Another reason is to have income to spend when they retire. In addition to their savings, most Americans will need additional sources of income for the years after they stop working. As you read in this section, you'll learn what those additional sources of income are and the amount of risk involved in these investments. In 1964, Warren Buffett took over Berkshire Hathaway. He believes in value investing, buying a stock because of a belief in the company's value for the long term. In 1998, the company's Class A stock sold for a high of $84,000 a share. In the 1970s, those same shares were selling for about $400. What other kinds of investments are available for people who want to invest over the long term? Investing for retirement. Most companies have pension plans, such as 401k, that provide retirement income. Some people will combine a retirement plan with their Social Security checks because Social Security alone is not enough. Personal or private pension plans have the benefit of tax savings. The KEO plan is an individual retirement plan for self-employed people, where they can save up to 15% of their income. Traditional IRAs, or IRAs, allow you to contribute up to $3,000 per year, which is not taxed when put in, and any earnings and interest are not taxed until the money is withdrawn. Roth IRAs, on the other hand, allow you to save up to $3,000 per year, which is taxed when put in. Interest and earnings are never taxed, and money is not taxed when withdrawn. So if you were trying to decide, for example, between whether you wanted to establish a traditional IRA or a Roth IRA, the things you would have to consider, both of them let you invest up to $3,000 per year. Now, if you choose to go with a traditional IRA, what this allows you to do, because you are not taxed when you put it in, this enables you to potentially put more into it if you're having a hard time coming up with the $3,000. This basically allows you to use pre-tax dollars so that it doesn't count against your tax. That $3,000 you put in would not be considered taxable income, which will lower the amount you pay in taxes now. But you're going to be taxed on that money when you withdraw the money. If, however, coming up with the $3,000 that you can put in per year is not a problem, a Roth IRA may be a better option. Because yes, you're using post-tax dollars, but you're never going to pay taxes on the interest and the earnings that you make, and you're not going to be paying taxes when you withdraw that money. Real estate is a popular form of investing for the future. Housing generally increases in value over time. Buying undeveloped land, however, is a more risky investment. It is hard to turn real estate into cash on short notice, which basically means that it has poor liquidity. You can't easily convert it into cash, which is something that needs to be considered. That is one of the downsides to investing in retirement. On the upside, if you know you're not going to need to gain access to the cash for a long time, it's a pretty sound investment. How much to save and invest? There are many factors involved in deciding how much to save versus how much to invest. You should invest in several different types of accounts to lower your overall risk. This is called diversifying. If you cannot afford any losses, use banks or savings bonds. Your values may affect your investment choices. Some people, for example, may have a very low risk tolerance. And for those people, going with a less risky investment makes sense. Other people have a high risk tolerance, and for them, they feel very comfortable and are willing to take those chances. But you also have to consider, what is your age? What is your status in life? For example, if you are a young individual, let's say you're in your 20s or maybe early 30s, you've got many, many working years left ahead of you. And you can make more aggressive investment choices, even taking a higher risk, because should you lose that money, you have time to recover. But when you get closer to retirement, people that are maybe in their mid to late 50s probably can't really afford. They don't have that many years left ahead of them should things go bad. So they need to play it more conservative. They want to go lower risk because there's just not time to recover should they take a big loss. So, and here's something that, a graph here that kind of shows what you need to take into consideration. Now, of course, the big thing here is that everything comes down to risk versus reward. And so when you look at this graphic, you can see along this axis they run risk, low running to high. And along this axis, you have the rate of return running from low to high. So down here, passbook savings accounts, those offer the lowest risk but also the lowest return. Certificates of deposit are moving up to a little bit higher return, but at the same time they take a higher risk. Bond-based mutual funds, once again, greater rate of return but a higher risk. Stock-based mutual funds, even riskier. Bonds, riskier yet, and stocks are the riskiest. But once again, as it moves along this trajectory, the further out you get, yes, you have a greater risk and a greater rate of return. So you always have to balance those elements, risk versus reward.